We've been speaking about so many different kinds of mutual funds, but they're all funds which are focused on the domestic market. But there is a category of funds which you can use to tap the international market. These are called the international funds, which invest in markets or companies which are abroad. Their only mantra is invest anywhere but here.
Yes, Sumera. Several of these international funds actually work on a concept of a domestic fund, which is called the feeder fund, which collects money from Indian investors, transmits that money to an existing fund abroad, which is called the host fund. That fund manager, who has the local expertise, manages that money of the Indian investors in the form of the host fund.
Well, the most popular feeder funds, of course, are the US ones, but then they can have exposure to any sort of geography. And the number of international funds in India may be small, but do remember that they have exposure to companies worldwide. And that brings with it a lot of advantages as well.
There are several advantages. Most of us as investors have a bias towards the country we are born and brought up in. That might not be the only destination for capital market investments. Besides this, you also get another diversification, which is the currency diversification. For example, if you bought a US feeder fund, your money, even if it's not optically changed to dollar, it is actually transmitted to the US in the form of US dollar. So your net asset value, which is the price of the unit, is also going to be appreciating or depreciating depending on the dollar-rupee exchange rate, which is true diversification to the next level. The third advantage from an investor standpoint is that if you have objectives which will require you to accumulate foreign currency in the form of global travel or children's education abroad, this becomes a good saving mechanism, and also it's growing at the same time.
So that's a lot of advantages, Firoz, but isn't the cost a big drawback?
Yes, it is. I think it's again a pertinent question, Sumera, because you have two funds superimposing each other. So the cost of one fund and the cost of another fund, the total of these two costs is what you need to be conscious about.
So I'm gaining in dollars, but I'm still being taxed in rupees, right?
Yes, I think tax treatment is a little unconventional. Any investment made abroad in the form of these feeder funds is categorized as debt from taxation, irrespective of the underlying being global equity. So debt taxation is lesser favorable than equity, so that's one demerit which you need to compute and see whether your post-tax returns are as lucrative as the domestic market before you enter any of those.
Okay, one more question, Firoz. As an Indian, we're also allowed to remit money abroad, right? Does this get counted in that limit?
No, it doesn't get counted in that limit. That limit is called the limit of the Liberalized Remittance Scheme, abbreviated as LRS. As things stand today, the limit is $250,000 per financial year per person. So that's the maximum you can remit under the LRS scheme abroad. But these mutual fund investments are not a part of that, and there's no limit to your investment when it comes to international funds.
So most of the international funds that we hear about are equity based. Are there debt international funds also?
Most international funds focus on equity as against debt because Indian debt already is at a very high interest rate, and the global debt markets might not have something as lucrative to offer for an Indian investor.
So even if I can't travel abroad, at least my money can, right? In mutual funds as well, there is a category which strives to strike a balance between equity and debt. These were earlier called balanced funds, and now they're called the hybrid funds. So they can invest in both stocks as well as bonds, and that's how they get their name as well.